The markets, especially the US market and some of the other global markets, went to all-time high towards the end of 2020, which created, to my mind, some kind of inequality between the people with funds and monies waiting on the sidelines and the real working class.
How do you see the markets in 2021? You think they'll be as ebullient as they were in 2020? And what are you worried about, if anything?
No, I don't think they will be as ebullient in the next year. So as we go into this new period, I think you're going to see a pickup in growth and inflation. And with that, you're going to also see a pickup in deficits. And that pickup in deficits means that the government's doing that, particularly the United States, will have to sell a lot more bonds to the rest of the world. So the supply of bonds will come to the rest of the world. I don't believe there's enough demand for those bonds when we look at the supply and demand picture. And so it's reasonably likely that by later in the year, you will have to see the Federal Reserve come in and buy more of those bonds to make up the gap. So it's going to be a very interesting and challenging year.
So, Larry, you have your pulse on the finger of what central bankers are thinking, probably more than anybody who's not a central banker. So are interest rates likely to go up at all in 2021?
The real question will be, is that underestimating wage growth as we rebuild our economy post-pandemic, the need for job creation as we create a large-scale infrastructure projects to rebuild our economy. We have $2 trillion of deferred maintenance in our infrastructure in the United States. So I would clearly say out 22, 23, we are building a new regime. I think when Ray and I started in the business, we grew up in an era of inflation.
So, Thomas, can you tell us in Europe, is Brexit going to be a good or bad thing for the European economy this year now that Brexit has more or less finally occurred? And are you worried about the level of debt that the European Central Bank has incurred to help keep the European economy strong?
Well, I think in the short term, Brexit was certainly not a good thing for Europe, for the EU, and for the UK. But, you know, coming from a country that is in the heart of Europe and is not part of the EU and is doing very well, I'm convinced that also the UK will do just fine over time. They will find their bilateral agreements, their trade agreements. They have a very strong financial center. They have a flexible labor market. So in the short term, it's a challenge, but at the same time, it also provoked some more intensive collaboration amongst the EU countries, and they came together for the recovery fund. They are talking about more collaboration on the fiscal policy side. So I think Europe has gone through a challenging time and was probably harder hit than most other regions also in terms of COVID. But at the same time, to some extent, it's undervalued. So I think there is a good chance that Europe will actually do better than maybe people think right now.
Yasser, how important are ESG factors to you when you make investment decisions for PIF?
Very important. ESG is basically one of the first things that we look into, especially the E part, because the E part is more objective. I have a problem with the interpretation of the S and the G and the standardization of the S and the G. I mean, it's very much objective in the E. How much you're omitting, how can you rectify these things? But the problem is, what's the interpretation, what's the standardization of the governance? And I will give an example. Putting a chairman and a CEO is accepted in the US and parts of Europe, but it's not accepted as part of the OECD principles. You have to separate the two. Now, which rating agency will pick this as a good point or a bad point? So the problem that I'm facing with the ESG is the different rating agencies who are all working on different standards of how they're evaluating the ratings.